David. Hi, investors. Today I have David Eva with me, and the reason we're doing the call is the shock announcement, and it is a kind of a shock to me because I was a bit shocked about it. The shock announcement about Gatehouse pausing all lending temporarily. Now, David is really is really my favorite mortgage advisor, basically, and we work together on a load of cases. And thankfully, David agreed to do the call with all of us to share his knowledge on what's going on. So, David, could you give us a quick overview of who you are, your experience in the market, and so on, and then we'll get into the Gatehouse question.
Sure, yeah. So I've been working in the sector since 1998. I've seen the ups, the downs, the good times, the bad times, and we're in unprecedented times at the moment. We've not really seen times where lenders are withdrawing products at a moment's notice. You know, we're getting emails in the morning saying to us that unless the case is submitted by 5 p.m, then the application can't proceed. And that's essentially what's happened with Gatehouse yesterday. You know, an email came in to say, unless your decision in principle is submitted by 5 p.m, then we are going to not take any more business after that point.
Wow. Okay, so just so everyone is really clear on this, if you don't have a DIP from them that is current, like, does the DIP have to be less than 3 months old for it to be valid?
I believe so, yeah. I believe it's 90 days DIPs are valid for, yeah. So as long as you've got a valid DIP, then you can execute that DIP. If you don't have one in place, then unfortunately you're going to miss out. So you're going to need to seek alternative solutions. So if you do have a DIP in place, you have until the 25th of August to submit all of your documents. So the mortgage intermediary or the bank need to have submitted that fully packaged case by then to ensure that the application can proceed.
So is there a scenario where somebody could, for example, pick a random house, as it were, and then just get their documents in or whatever? I know that you shouldn't do that, actually, but is there a way that somebody can get a footholding in so they can get their application processed?
I mean, ordinarily, what would happen is if you submit a mortgage application, that the property that's on that application would have to stay on that same case. So it's unlikely that they would allow you to change the property if the application is already submitted. However, I have known them make exceptions in the past if the valuation had not been instructed. So you could chance your luck and submit a case with a property on there, but it's quite possible for them to actually turn around later on in the process to say, no, sorry, if you want to change the property, it's a fresh application.
I think also one has to play a very straight game with the lenders, and doing this kind of tinkering around is just a bit risky, isn't it? And it's not good for your reputation as well. Okay, so they've said that they're going to have a moratorium until further notice. Is that right?
That's correct, yeah. So they're withdrawn from the market until further notice. I mean, we have seen them do this in the past, and they were typically out for 4 to 6 weeks. I mean, it's not a case of the bank's in trouble. It's a case of they can't cope with the volumes. So
okay, so in your experience, what happened last time round?
So they left the market for about 2 months, I think it was. But this was really due to the pandemic. And that's when the market just didn't know what to do. They didn't know how to react. And they didn't want to be in a situation where they were left with all of the cases that nobody else wanted. Right. So just really for safety reasons, they pressed pause. But I mean, so did a number of other lenders. They did exactly the same thing. They pressed pause on new cases. And we've
So
seen that with other lenders in the marketplace as well. There are a number of lenders at the moment who have said, we're pausing new applications, but purely to protect the service levels for the existing customers. It's not something to be concerned about as an investor. So if you have a Gatehouse mortgage or Gatehouse finance product, I should say, that the bank's in any financial trouble, it isn't.
So I'm clear on this then. They press pause, they clear the backlog, and then they get back in, as it were. How long do you think it'll be before they reopen for new applications?
If I was going to hazard a guess, I'd probably say about a month, because there are factors as well the bank's dealing with at the moment. It's summer holidays, so they are going to be short-staffed. So they've got that to deal with a raising rate environment as well. It's just all these things coming to a head at once is causing them really to press pause. So, I mean, I'm not concerned, but it's just really, it's very frustrating because they're very good lender to work with for foreign investors. So it's a shame to see them sort of step out. But there are alternatives which we can discuss.
Yes, exactly. And I'll do some screen share and we'll go through all of this because you've got an investor pack which is really helpful. And anyway, but going back to the Gatehouse thing. So let's say they reopen in a month. Do you think they'll continue their minimum £75,000 mortgage offer? Or, in other words, the problem occurred because they had an avalanche of applications. So do you think they'll just carry on as before, maybe hire some more people, or what's going to happen, do you think?
Yeah, I think they'll come back to market. I mean, they've not indicated at all they're leaving the sector at all. And when this happened before, all they did was just come back with sort of one or two products. I mean, at the moment, you've got a choice of products. I think there's sort of there's 6 products to choose from. So I'd expect them to come back, but they'll just put their toes back into the market gradually, and then we'll see them open up again. So just said, I wouldn't anticipate it out for longer than a month.
So my theory is that they'll look at what caused the avalanche of new business and then work out where their greatest profitability is, and then carve out the good stuff, carve out the good work, as it were, for themselves, and then dump the bad stuff. So the question is whether those low £75,000 mortgages are worth them keeping. I don't know.
That is the $1 million question, isn't it? And if I recall properly, when they came back last time, they did raise the bar. So the loan sizes need to be higher, because really for the bank, it's the same amount of work for each case, regardless of the loan size. So it would make sense from their viewpoint to really raise the bar to make sure they're getting the bigger loans in, because then that's greater profit for them.
Well, 2 things. Do you hear background noise on your end from me?
No.
Okay, good. All right. The noise isolation is good on this end. All right. Let's share screen and let's talk about... Oh, no. Before we get into that, can we just talk about the market in general? Just what's going on, the climate. I know you touched on it earlier, but could we go into more depth? Because it is very interesting. So you got Gatehouse pausing, but what else are you seeing? Where else, as it were?
Well, I think I pretty much touched on it before, is that it's a very fluid situation. So lenders are withdrawing products at a moment's notice, and it's really, really difficult to pin anyone down at the moment, because they are trying to protect their bottom line. They're trying to protect their service standards, but in this raising rate environment, they don't want to be left with all the other cases that other banks don't want.
Right.
So if one bank raises rates, you tend to see a lot of them will follow suit. And one other sort of key theme I'm seeing at the moment is the service levels have just gone really bad. I mean, I don't know why it's happened, but all of a sudden, in the last sort of 3 to 4 months, the service levels have really dropped with pretty much most banks, even the mainstream banks. So I don't know why that is, but if I was to hazard a guess, I think a lot of people are trying to fix their mortgage rates in this raising rate environment, and a lot of the banks are sort of inundated with applications.
Yeah, that makes sense. And in terms of service time, service levels, and mortgage approval times and so on, what would you expect? Say, for example, Gatehouse, what's the typical mortgage processing time with them these days?
Well, I
Well,
think
before the pause, of course.
before the pause, yeah, because no doubt there's going to be a lot of cases coming in sort of today and next week. When I checked the website yesterday, I think they were working on tasks that were raised on the 20th of July. So probably about 4 weeks before they'll review anything that we put on their system.
Wow.
at the
Okay.
moment. Yeah.
And how long to then process the mortgage to completion to pay out?
Well, that depends on the solicitor. But you know, anything between sort of 6 weeks, 6 to 8 weeks after that is quite standard. Yeah. So I mean, that
Okay.
bit's as normal. It's just more getting to that stage, which has slowed down dramatically. So I guess really the takeaway here is that make sure you get your packaging right first time, because you really want to minimize the back and forth between you and the bank. So really pay careful attention to what's required, and make sure you go through it properly and provide everything, because you do need to pay very close attention to all the detail. Now, for instance, if you look at Gatehouse Bank, one of the things that they want to see is a transaction list of anything over £10,000, and you need to itemize it and explain what it is. I mean, that's not for every bank, but that's for them. But if you don't provide that, they're just going to ask you to do that when the case comes in, but you've already waited 4 weeks to do it. So you should really be trying to be ahead of the game, really.
And is this the same? Is this the same for other banks as well? Are they kind of getting more fastidious about their administration? Because obviously higher interest rates, higher risk, and therefore, they've got to mitigate risk by being careful, perhaps.
No, I mean, it is, that hasn't really changed. It's just really I'm trying to make the point that you really do need to spend some time on the packaging of your mortgage application. If you want it to go through quickly, then make the bank's job as easy as possible.
Yeah. Well, with that in mind, I'm going to do two things. I'm going to close the window because I can hear the builders outside, and then we'll get into the deals and stuff. I'm just afraid because this is an important call, and I hope a lot of people are going to be watching this. So be right back. There we are. Okay, let's share screen and let's get into the document. And I will just close a few things, and I've got the investor pack here, and I'm gonna share, as I say, share the screen. Here we go. Okay, let's do that, and I'll make it bigger so we can all see it. All right, so David, I think there's a couple of things to say about this for everyone. Generally speaking, they're like the main lenders in town, like Gatehouse, Hampshire Trust, and so on. And David, you may want to talk about this as well, but just the reason we are David wants to not reveal the name of the lenders for some of these sources is because, as you've just seen with Gatehouse, if they get an avalanche of applicants, then they just shut up shop, and then you've got a problem. And a lot of these lenders are quite niche, the ones that David deals with, and oversubscription is a danger. So the lenders would love to get more business, but there's this kind of conflict where if you overexpose a really good lending source, it just gets oversubscribed. Would that be the case, David, or am I just?
Yeah, I think that's a fair statement. Yeah.
Okay. So that's why it's important for David not to necessarily reveal who the lender is. But I've talked to David at length about all of this, and I know who the lenders are, so they check out well. And with that in mind, let's go. So do you want to talk us through this?
Sure. So I think we'll talk about lenders 1 and 2 because they seem to be the ones that are most or going to be most relevant to your client base.
Mm-hmm.
So for lender 1, the most important thing there, point 1, is for them to see someone who's got an active credit footprint.
Mm.
So for them, we're going to need you to provide a bank statement, really, or some kind of mortgage history. So a bank statement can actually be a UK personal bank account. That will still create the credit footprint. But for them, their theory is they don't really want to be dealing with a ghost. That's kind of the way they put it to me. They've got to be able to trace you. You know, if you own a property and say you've got some utilities as well, then that would show on your credit report as well. So that would help them.
So can I just kind of dig into this a little bit more with you? So I've had this with a few clients where this lender, who I think the lender I think you're talking about, they the client that we had, or one of the clients we had a tied bank account, TIDE bank account, and there are certain bank accounts which can give you, which are designed to give you a credit footprint. Is that right? And you need a month. So how can you just talk through this, because this is very important for people to understand. So can you just talk about the process of getting a credit footprint?
Well, it will automatically happen, really. So you don't have to do anything as such, but you just need to make sure you have certain accounts. So Tide actually offer a credit building service. So you could pay for a subscription to a Tide credit builder, and that will help you build a footprint.
And how long does the account need to be live for?
It just needs to be live. So the point really is that they don't want to be dealing with someone they can't trace. So
yes,
as long as there's a footprint of some description of that individual, then they'll consider working with you.
Okay. So we've got a classic scenario where we've got a foreign national limited company buyer. They haven't bought a property in the UK yet. They are now very anxious about Gatehouse, because Gatehouse could just pull the plug again in the future, and that would mess up a lot of plans for a lot of people. So let's say with lender 1, what apart from talking to you, which is what I suggest they do, what do they do just to get their credit, just the outline of how they get their credit footprint underway? So they set up a Tide account.
And apply for a credit builder. So they've got a service where it's a subscription service, but it's worth paying for. It's not a lot of money.
Mm-hmm.
That's one way. Or open a personal bank account. So HSBC UK offer personal bank accounts as well as limited company ones, although I know they're harder to get the limited company ones. But a personal bank account would still count, because they can search off the sort code and account number that you provide to us. Or if you already own the property, then you can just make sure you get the utilities in your name. So the gas, the electric, that type of thing. They now show on credit reports. So that will help you as well.
So on the personal account, I know that a lot of our clients use HSBC, HK, Hong Kong.
Yeah.
So I assume that HSBC would allow a personal UK would allow for, they'd allow their customers to have a personal UK account for whatever reason they wanted it, I assume. But that's something that, as those people watching, you're going to need to talk to HSBC about this. But as I understand it, Tide, it's quite straightforward. There aren't any real conditions to speak of. You just get on, you pay your money, you put some money in the account, and then a period of time passes, and then you're good. I seem to remember Tide the bank we're talking about demanded a 1 month. You demanded 1 month of credit history or credit footprint. Is that right? Or is it just 1 day?
I'm not sure about that. I mean, I thought they were relatively straightforward to open. I just think that, like, the one parameter that some people struggle with, I think, is you need a UK number. But you can get a pay-as-you-go SIM quite easily nowadays, can't you?
Yeah.
So I think that's the kind of way around it.
Or a UK or a virtual UK number, perhaps.
Yeah.
Okay. So we need to, anyway, right. Okay. So let's say that's all sorted out. So you got the UK credit footprint.
Yeah. Okay. Then sort of the other sort of parameters you need to be mindful of really is personal income. So if you're a first-time buyer, first-time landlord, then they want to be working with high net individuals really. So they'll consider someone without the required experience because they normally want 12 months experience as a landlord. If your income is over 75,000 and you own your main residence in your home country.
Right.
So
that's £75,000, just to be very clear.
Correct.
Yeah.
Sterling. Yeah.
Yeah.
Okay. And what we've seen in the past is they've agreed them, but at lower loan to values as well. So if you're only at 75,000, it's still a large sum, but you may only get 65% with them. But if you have a bigger income, say 100, 150, then you may get 75%. I mean, it really is going to be their discretion, but just prepare yourself. They may turn around and say to you, we're only going to offer you 65% on this first deal.
And
that's work for some investors, mate.
Yeah.
Because the rates are better at 65%.
Well, they are. So just so I'm really clear of this then. So if for example, somebody goes below the threshold, the 75,000, if they're at 70, for example, would they still be considered?
I think so. Yeah.
Right. So it's a general guide, but if it was £50,000, for example, then they probably wouldn't be considered. Do you think?
I think that's fair. Yeah. I think you would have to go somewhere else if it's a first-time buyer. Yeah. Or first-time landlord. Yeah.
That's fine. And then, and when you say own a personal residence, does that mean that just simply means you have a property? What if they have a big mortgage on the personal residence? Is that an issue?
Yeah. No, it's not an issue at all. No, it's just a criteria point they want to be working with, ideally. People who are not first-time buyers, so this isn't their first property purchase. So they could be a first-time landlord, but not a first-time buyer in that sense. But, I have seen them approve them first-time buyer and first-time landlords if there's, if it's a very high net individual. But I mean, most people who are on big salaries tend to own their house anyway. So it's not very often that happens.
Okay. And now the next thing is the experienced landlord, and that's all fairly straightforward. So they got a property and they've owned it for a year and it's an investment. So that's very straightforward. This is quite an interesting one.
Sorry, just on that point, Nick. With that, there isn't really going to be a minimum income at that point. So once you've got the 12 months experience, we drop this 75,000 requirement. It's then if you're on 20,000, 50, it's fine. It's more to do with experience for them. That's the key driver with their lending policy.
Got it. Okay. This is good. So that speaks for itself. That's interesting. And also, in respect to the terms, I mean, the duration of the mortgages, what typical terms are we looking at here? And we will talk about interest rates and all of that shortly.
So they allow up to 30 years on an interest-only basis. You can have, I think the minimum term is 5. But, if you are taking an interest-only mortgage, I can't see any reason why you would not opt for the maximum term. It doesn't affect the payment, so you might as well secure the property for the bank's prepared to do that.
Okay, and then we're into the number and value. That's good. So what they're gearing up for, I guess, are people with experience, essentially. So they're trying to attract portfolio borrowers, I suppose. Okay, and then we have HMOs. We don't really do much with HMOs, and I'm glad because they're just a rather kind of messy end of the market. But anyway, that's fine. So that's all pretty self-explanatory that you've got to have a license, etc. And this is quite an important one. So a lot of our clients love the Gatehouse £75,000 minimum mortgage, and it opens up the lower cost properties to them. But they have a reasonable amount of cash around the place. So in theory, they could buy two properties, lump them together, and off they go. But could we just talk about this in more detail, because it's a constant kind of thing that comes up. Let's say we've got two properties. They're both £100,000 each. So they're high yielding. They yield, say, gross rentable yield, i.e. cost of property plus renovation equals gross rentable yield, 6.5 to 7%, let's say. So great. These are nice properties. They work in these higher interest rate environments. How would you organize things so that they could mortgage properties together with minimizing cash exposure? Is there a way of doing this?
Yeah, I mean, although the lender has a minimum value of 135,000, you can put two properties on the same application, because really for them it's about the loan size. That's why there's a minimum value of 135, because their minimum loan is 100,000. So as long as the aggregate number of the value is, over 135, then we will meet the minimum loan size. So you can even drop it down lower than that. So you could go sort of 170, another 170, and have 140. You can go as low as that with the lender.
Okay, so we got
that can be quite handy.
If you imagine a scenario where, for example, you got an offer accepted on a property, so you initiate a mortgage application, and obviously if it's over 135, fine. But imagine it's £100,000 property, you initiate the mortgage application. Now you need to get an accepted offer on another property. Are you able to combine two properties in a single application? Or do you have to buy one for cash? And, how does that all fit together?
Yeah, I mean, you can buy two properties simultaneously if you like. And we have done them in the past, but I would put a little bit of a risk warning here, is that they have to complete at the same time. So you may be in a situation where one's ready to go, but the other one isn't. And it could jeopardize the other sale if that one keeps dragging on. So these work better. Sorry.
Yeah, go on.
So I was going to say, so where these work better is where you have one that's cash and you want to refinance one to buy another one, because you control the refinance completion side. You're not really concerned about that, and the purchase can complete when it needs to, and then they can both go through the same day. So whereas if you're doing two purchases at the same time, you've got to line it up so they both complete on the same day, because the bank will release it in one tranche. You won't get one bit for that property, another bit for that property.
Okay, so the scenario of so we just think of a few different scenarios. Scenario one, it's got to be over 135,000. Scenario two, it's you've got a mortgage application going. You basically get two offers on two properties, and you complete on the same day. Very high risk, probably can't happen. Scenario three is you have already purchased, or you've got a property that's completed, you've bought that for cash, and then you've got your other property that you're now in the process of purchasing, and you run an application on that property, and then you're effectively doing a mortgage to purchase one property, and you're refinancing, and you're kind of combining both situations together. Equals your £135,000. Is that it? Yeah.
Correct. I mean, it will be. It'll be one mortgage across the two properties. It'll be a portfolio mortgage. But yeah, that's how the bank would view it. It'd be one refinance, one purchase, but on one application.
Right.
So it's
that's
really
interesting.
handy sometimes. Yeah. To get around this 135 rule, you can combine two properties. So Gatehouse don't do that. That their policy is that it's one loan per property. So it's a really good way of actually getting the lower price properties, because at the moment, they're now not taking new business, but I think their minimum property value is about 94,000. Whereas with this one, you could actually go as low as 70 maybe, and do 270s and then get them on the same application.
Yes. So to reiterate, because this is a very viable approach, that it's it's one property. You purchase property number one for cash, and now it's in the process of conveyancing. It's say a month ahead of property number two, so it's likely to complete before property number two. And then you are the owner of property number one. Property number two gets towards completion. You're the owner of property number one, so you're combining a refinance and a purchase loan together, and that gets you over the line with the minimum mortgage size. Is that right?
Yeah, more or less. Yeah, that's pretty much the scenario.
Okay.
And there's lots of ways you can do it, and you can even extrapolate that out even further. You know, we've done 5, 6 on one application. You know, so it doesn't just have to be 2; it can be many more than that.
Okay, very good. And I know that you are especially experienced with this lender, that you've worked with them for years, so this is good. Okay, so the next thing is non-standard. We always avoid non-standard. So for a good example of non-standard, by the way, would be wooden framed houses or system built houses. So these might be ex-local authority houses that were made of concrete slabs, and they were prefabricated, and they're a thing you see from the 1960s. Often they're clad with insulation cladding on the exterior because they were so badly made. But anyway, that's your classic. Okay, knotweed, yeah, that's a non-issue because we keep a track of all that. Okay. All right, this is quite interesting. Guaranteed rents. We tend not to deal with local authority tenants, but can you just talk about that guaranteed rent plan thing a little bit more?
Yeah, so with guaranteed rent plans, what happens is a third party will agree a rental agreement with the landlord, and they will then essentially sublet the property. So what happens is that although the landlord's getting guaranteed rent and they think, well, that's great, I can show the bank that I've got rent coming every month. A lot of the banks don't like that because really the landlord doesn't have a tenancy agreement with the underlying tenant. And in the event of a repossession, it's a much more convoluted process to actually evict the underlying tenant because the landlord who they've got the loan with hasn't actually got a tenancy agreement with the underlying tenant, and they've got rights. So really, most banks don't like that scenario. So really, you want to try and avoid that if you can. We do have lenders who do accept it, but you'll have to pay a premium for the finance. So you'll have to weigh that one up as an investor, whether it's worth going down the guaranteed rent route or not. But if you want to achieve the best rates in the market, and that includes Gatehouse, guaranteed rent plans will not be accepted.
Okay. Social housing tenants. We've got a case at the moment where we've got an offer outstanding on a property and it's got a social housing tenant. But as you say, it's a direct tenancy agreement with the landlord. So that's exactly what we have in that scenario.
Yeah.
So that's a non-issue. Okay, the stress test. Could you just quickly,
Yes.
Could you explain the stress test, what it actually means? And by the way, I know there's a lot of pages here, so we'll be skipping through a lot of this, but this is kind of the key stuff.
Yeah. I mean, we do
David.
explain in the pack actually how to do the stress test for those people who do want to understand it in more detail. But just as a high level sort of piece, the rental income needs to be a certain percentage above the mortgage payment. Yeah. So 125% stress test means that the rental income should be 25% more than the mortgage payment. So you obviously have to work out what the mortgage payment is, and then you can then work out what the rent needs to be. Now, that applies to 5-year fixed mortgages. If you're going to take a 2-year fixed mortgage, you need to adjust the interest rate slightly. But, you know, just for the purposes of this sort of chat, to keep it nice and simple, if you take a 5-year fixed mortgage, then the rental income needs to be 25% more than the mortgage payment.
Well, that's a very achievable sum based on the yields that we're seeing all the time. I know that some lenders go up to 145%. Is that right? So for personal mortgages, it's 145.
That's
is it?
Correct. Yeah. That's right. So for limited companies and individuals, it's slightly different. So the stress test is more generous if it's a limited company. So it's actually in your benefit to do a limited company in that scenario.
Very good. And then we've got...
And it's also worth noting as well, it's also worth noting as well, I guess, is that the banks aren't really looking at people's income at this stage, because the rental income is what's essentially paying the mortgage.
Yeah.
So that's why this is really handy for investors to use this method, is because you're not going to get to a stage really where the bank's going to say, look, you've got too much debt, you can't afford it. That's how you can keep growing and growing your portfolio, if the bank uses that method to assess the affordability.
Okay, so the next, we talked about the minimum personal requirements, holiday, yes. And then, okay, let's talk about the loan features, because obviously that's what people are interested in. They want to know the numbers. So here we go. All right, well, these rates are interesting. So I know that Gatehouse were at 5.19%, I think it was. Is that right?
They were yesterday, yeah, 5.19 for the 2-year and 5.39 for the 5-year.
Right.
So these are a fixed rate. Yeah.
So obviously these rates are a little on the higher side. Eddie, have you any comments about this?
I mean, we've just seen unprecedented rate hikes by the Bank of England. So the banks have increased their rates really in line with what the Bank of England have done. And they've come from real lows, really. You know, 4 or 5 months ago, they were down at something like, I think, 3.9 with this lender. So you can see that, you know, they have got higher off the back of those rate rises. So yeah, it's
and do you have just in respect to interest rates, the kind of the leading question is always going to be, well, do I wait because maybe rates are going to go down or not? So do you have an opinion on this?
I do have an opinion, and I'm not sure I could say it, but or perhaps I will. I think it's inevitable, isn't it, that with the Bank of England raising rates as much as they are, and inflation still around about 10%, that it's going to start to bite soon. You know, and if it's going to start to bite, then it is going to affect the wider economy. So if I was a betting man, I would be betting that I think sort of maybe Q2 next year that they will have to start cutting, because the economy is going to need that boost. Because we are seeing slowing in the house market now, aren't we? It is starting to bite. So
I agree.
I think personally that they will come down, but you know, they've got license to keep raising at the moment. That's the problem, because inflation.
Do you know, just I'm going to quickly show you this. So this is stuff that I keep talking about incessantly, but this is inflation and interest rates, base interest rates going back to 1900. And what we're going through right now is what happened in World War II. So you had the war and you had huge supply side inflation, a lack of people in the workforce because they were out fighting. And this time round, we've had what they call the Great Resignation. So huge number of people just said, I'm out of here, done. And also with Brexit, that's affected immigration. So it's meant that we have a big supply shortage of labor and we have a lot of inflation. Anyway, what happened was in low interest rates, incredibly low interest rates, actually, after the 1929 crash. And then you can see interest rates kind of nibbling up for a while and then dropping back down. So after World War II, there was basically another supply side shock, and interest rates remained relatively low. So this is very analogous to the 1940s, not 1970s, 1940s. And a lot of it comes down to government debt and also trying to reinvigorate the economy. So I agree with you, David. I think that's what's going to pan out, which then takes us into what would your strategy be if you were an investor, a foreign national investor? What would you do? in respect, you've got inflation eating your capital, so you've got to invest that money. You also know that the Hong Kong dollar is really quite strong against the pound, so it's good time to buy. But you also know there's a fair chance of interest rates dropping. What would you do?
Yeah. I mean, well, in that type of backdrop, then you would try and look for a 2-year fixed mortgage, because then you can renegotiate the terms in 2 years' time, because the penalty clauses will end on the contract. Yeah. So if you're of that view that interest rates are going to come down, then try not to tie yourself into a longer term fix, because once you take the 5-year fixed, if you want to change it, the penalty clauses will apply for the 5 years. So Nick, I don't know if you can scroll down a little bit, you can show people what the actual early repayment charges are. So they are, so it's 4% in the first 2 years, and then 3% in years 3 to 5. So it would be quite a significant hit to refinance. So if you've got that view, then take the 2-year fixed.
Yeah, I think we both feel that 2-year fixed is probably the right way to go with this. And here's the 2-year fixed. So really at these kind of interest. So, okay, there's a dilemma here, which is that Gatehouse is cheaper. But the problem with Gatehouse is incredibly long processing times. And I know this, and I've had a few deals collapse because Gatehouse just took so long. The vendor just was screaming and pulled the deal at the last hurdle, basically because they just got tired of all of the hanging around. But I know this bank are relatively quick on processing. So arguably there is a strategy here, which is go for a couple of lower value properties, just get your 2-year fixed in, make sure everything's cash neutral, or you're getting a bit of income out of it, and then just let it sit for 2 years and then reassess when the mortgage comes up, and you go from there. So that's what I would do. But
yeah, I think that's fair. I mean, especially if you've got that view, I think really it's going to come down to each investor's view of interest rates.
Yeah.
So if you've got the same view as Nick, then perhaps you should be looking at 2-year deals.
Well, it's just the thing with history is it never ever repeats itself, but it absolutely rhymes. And when people and economies are facing similar kind of stresses, then policymakers behave in similar kinds of ways, as it were. And, one of the other things to remember about the 70s versus the 40s is that 40s was a period of incredibly high government debt relative to GDP. And because of all of the COVID problems and stuff, debt to GDP is now hovering around 100%. So it's getting quite high again. What that means is that when governments raise base interest rates, they raise the cost of their own borrowing substantially. And that then creates a negative cycle where they then have to increase taxes, or they have to sell more bonds or whatever. But if no one's buying, then they've got a problem. And so it's all about a balancing act. And so this is one of the reasons, according to macroeconomists who study these things, one of the reasons why interest rates didn't go crazy despite high inflation was simply cost of government debt. And people like Ray Dalio, their whole thesis is that it'll top out at 3.5% base interest rate, certainly for the US, and the UK is kind of follows a similar path. And that's again due to cost of government debt. So I think as long as you can find a high yielding property that just makes sense, even at 3.5% base, then you're good to go. But obviously you get a 2-year fixed in, you're all good to, you're set. All right. So let's have a look at this. So this is lender 2. Any particular differences in what they want from a buyer? And then we talk about the numbers.
Yeah. I mean, the main distinction between this and lender 1 is the minimum loan size is only 50,000.
Wow.
So you can look at standalone deals at 70,000 and just put it on a product with them, and then look to review it again in 2 years' time. They'll also do portfolio loans as well if you need to, but I guess you wouldn't need to if you're only just buying one property at 70,000. you could just take a 2-year deal with them. But their 2-year deal is a 2-year deal. That's the end of the loan. So that that first column, or second column, I should say, 5.49 headline rate there. It's a 2-year deal. So you will need to either extend with them in 2 years' time or refinance.
Can you talk us through this? So this is a really attractive deal on the face of it, like minimum loan 50 grand. Interest rate is acceptably low, high, whichever way you want to look at it. So, all right. So the scenario is somebody gets this, buys their low cost, high yielding property. Now, from memory, this bank are they're almost like a bridging lender, almost. You know, they're quite easy on requirements for the properties they're lending against. Is that right?
Yeah, that's right. And you don't need to be working. Whereas with Lender One, if you was a first-time landlord, you would need to have employment, a steady job. With these guys, that's not required. They'll want to understand your source of wealth, because if you're not working, how have you got the money to pay for the deposit? But there isn't a requirement really for you to be working. So we've used them in those scenarios quite a lot over the past few years for those type of investors who are just maybe on a career break or are actually retired and don't actually want to go back to work. You know, this is a really good stepping stone to create your credit footprint.
So there's a few things here, so I'll start with the burning question. Right, it's a 2-year term, and let's say you get to the end of your 2 years. What would you do then? So I've got my mortgage with these people, and I've now fast forwarded 2 years. What's next?
Well, in 2 years' time, you would, in theory, have to pay back the loan, but they do reserve the right to offer you another 2-year deal at that time. Now, the reason that is only for 2 years is because they have funding lines, and that funding line is only there for 2 years. That may not get renewed in 2 years' time, so that's why you only get a 2-year loan.
And the cost of the extension, what's that?
They would charge you another product fee to extend the loan for another 2 years or whatever's available at the time. You know, they may even offer longer term. And if you look at the middle, sort of the 6.49 and the 6.19 columns, they will offer 25 years. If you look at the maximum term, you know, you can opt for longer terms but at higher rates. So, if you're concerned about the mortgage running out, well, the options there to, take a longer term mortgage with them, but there's a premium for that insurance.
Okay, so at so there's another. All right, so it sounds to me like the way to do this is to do a combo lender thing. So you bank in with these people, and it's effectively like a long-term bridging loan.
Yeah.
And we'll talk about criteria and all of that shortly. But you then refinance with Lender One. Is that how you would play the whole thing?
Yeah, I mean, or even Gatehouse. It just depends on the deal at the time. Yeah.
Right. Okay.
If the property's worth enough, then you review the situation, don't you, in 2 years' time? Or really, we wouldn't let it get that far. You know, at 18 months, we'd be reaching out to the investor to say, look, you do realise your loan's going to mature. Let's look at reviewing your portfolio and let's see where the opportunities are. Let's see what we need to do with this particular property.
Okay. This seems like a really smart thing to do. If they behave like, for anyone watching, David, could you explain a tiny bit about bridging loans and not why they're faster, but just the characteristics? Like, bridging loans are all about fast money, aren't they? And this lender is almost, so when I say they're kind of like a bridging lender, is that true? And what about their processing times, for example?
No, I mean, they would class it as a mortgage. They wouldn't class it as a bridging loan because they're going to expect it to be in a certain condition. So, like with bridging loans, you tend to use those products when a property is dilapidated and it can't be rented out from day one. So these are mortgages because with any long-term mortgage, the lender expects the property to generate income from the day the funds are released.
Okay.
So they will expect that with the properties you buy. So please make sure that, when you're, researching your deals that you can let them out. I mean, you can do a little bit of TLC to the properties, like a lick of paint, but it should really have a running bathroom, kitchen. That should all be functioning.
Right. Okay. So it needs to be in kind of what I would describe as minimal rentable condition. So in other words, in theory, you could rent it out. So it would have, for example, electricity certification, gas certification. It would be able to achieve those things. So you shouldn't buy a property which needs rewiring or has no boiler or knackered boiler or whatever. It's got to be it's got to be in actual rentable condition, but that doesn't mean it has to be tidy. It could be decoratively, it could be a complete mess, but it could be rented out in theory. Is that right? Is that
because if it isn't in a great condition from a rental perspective, that will just then affect the rental income it can generate. That's all. So it's just, can it be rented is the question, yes or no.
Great.
So yeah.
Okay. All right, so we've got the LTVs, so they're reasonable. 70% is okay, and also there's one small detail here. This deferred interest. Can you just explain what that means? Optional deferred interest.
Yeah. So the investor has the option here to defer 1% of the total interest bill up front. So although the loan would be at 70%, because it is capped out at 70% for international investors, you can opt to deduct 1% per annum from the loan advance, so that your actual mortgage pay rate is at 4.49. So the headline rate is still correct at 5.49, but what you've done is you've paid some of the interest up front essentially, and then they will then charge you 4.49 because they've deducted 2% of that of the interest from the loan advance. So it works for some investors because it keeps your cash flow down on a monthly basis, but really but just please bear in mind that you'll have a smaller loan amount at the start by taking.
So in other words, if you, I think I understand that. So in other words, you need, call it £100,000 property, you need £70,000 because 70% LTV, or 75% LTV in this case. So you need £75,000 debt on the property, and they got a 1% optional deferred interest rate. So they'll do a calculation. They'll say that's worth £3,000 or something over the term of the thing, and therefore they're going to lend you 70. They'll lend you 72,000.
Something like that. Yeah.
Yeah, got it.
Right, but it is 70% for foreign investors. Just to make that point, it isn't 75.
70%.
70 for foreign investors. Yeah.
Very good. And MUFB, multi-unit
freehold block. So it's two flats or multiple flats on one title. They'll accept those. Interestingly, HMOs and even semi-commercials there as well. So if you fancy one of those, it's available.
Yeah, this lender is really interesting, just generally. Okay, so now we've got criteria, which is very important. So, right, so lender one, you've got to have a credit footprint. The interest rates are better. The duration of the mortgage is longer. But it's just the minimum loan size is higher. And the catch-22 is that there's a lot of value on the lower end of the market, the £100,000, £110,000 properties. The yields are just so much higher, and I know that we can find loads of them. We do, and they're good value for people. So they want to grab them and hold them. Lender number one is difficult. So okay, sorry, I was kind of wandering a little bit here. Can you talk us through this?
So you don't need to have a footprint. You can apply from overseas with no bank account. I mean, you will need to set up a bank account at some point because you've got to pay the mortgage payment, but it's not going to be like a pre-application requirement like with lender one. So you can literally apply from pretty much anywhere in the world, providing it's not in a high risk jurisdiction. And most of the people you're dealing with, I know, are not. Yeah, I mean, they'll consider pretty much any application if it makes sense. Really, there's no minimum income. First-time buyers are allowed. And yeah, you don't need that footprint. So pretty much most people qualify for this lender, providing the property is, the numbers work on the property. So the yield's correct, it's enough. And if you scroll up a little bit, Nick, you see their stress test, I think, is 120%. Is it?
Yeah.
Yeah.
Yeah,
So
120
it's
for
a bit
comfort.
lower than lender one, isn't it? So there's more scope there to borrow a bit more.
See, this is very interesting. So in theory, if you're a buyer and you just want to get your money out of cash because inflation is killing you, basically, which and it's hurting everyone. Yeah, this just feels like a very sensible option. So what are their processing times like?
They're not too bad. I mean, we get a decision in principle back within 1 or 2 days.
Mm-hmm.
And then after that, an application form is sent out to the investor. So depending on how quick that comes back from the investor, it's normally about 3 days, 4 days after that, when an underwriter has assessed the case, sent a list of outstanding items, and the survey is instructed at that point.
Wow,
So, you know,
that's quite
if
quick.
you act quite quickly, you can get it done within 5 to 6 days, really, get the survey instructed.
So if you think about time from application in, i.e. you've packaged all the documents so that the gun starts, bang, and you're in, to money, being able to draw down money, hypothetically, if the conveyancing was instant for the sake of discussion, and it was just mortgage processing time, how long would you be looking at with these people?
4 to 6 weeks, I think, after you've got the offer. You know, just normal conveyancing times, you know.
Right.
And I can't stress enough, the quality of the solicitor is the key thing here. You know, you've got to choose a good solicitor.
I was going to talk to you about that because this is an issue.
It's such a problem for us in our sector that we can only take the investor so far in the journey. So we'll arrange the money, which in my view is probably the hardest bit, to get the lender to approve the loan. But then the baton passes on to the solicitor to do their bit. And we really are at the mercy of them doing an efficient job.
So solicitors is a really interesting one. As anyone watching, if you look at all of, we just have a lot of deals on the go, and we deal with maybe 4 or 5 main solicitors. And what we find is that they're open for business, they're taking cases, then they just get overloaded with cases, then they pause. And so we kind of move cases around different solicitors, just work on the basis of their quality as a service provider, but also just service time because they get overloaded. Now, with this, have you got solicitors can handle this work with this lender?
I do, yeah. I have got someone who and I don't recommend solicitors. There's only one that I would actually work with and stuff I use for my personal stuff. She's the only one I would feel confident saying if I introduced you to her, she'd do a good job.
Okay.
So I've got someone, and you've got to remember as well, they've got to have these requirements. So lender requires a borrower to choose a solicitor with at least 3 SRA managers. So exactly. Really make sure you do your research on that bit, because I've seen a couple come through, but they've only got 2, and we have pleaded with them, and it was categorical no. So
yeah, I've seen this as well. This is a real, and by the way, this is the kind of gotcha that just messes everything up, because if you switch a conveyancing solicitor midstream, it's so disruptive. So anyway, the point being, and I'm just going to go back to a theme here, which is that when you have a really good lender, unfortunately for the lender, it's a very bad idea to broadcast who they are, because then they get oversubscribed and then the party stops. And it's exactly the same thing with solicitors, by the way. And that's why we, as I say, we have a panel of solicitors we like, and we kind of rotate cases around just because, for this reason. Okay, so you just so I'm really clear, if somebody goes to you, David, and says, look, I'm interested in lender, whatever it is, lender 2 particularly, then you would be able to confer with your solicitor, the one you like, and just make sure they got case availability. If so, you would recommend. Is that how you do it?
Yeah, exactly how we would do it. Yeah.
Fine.
because not all
All right.
solicitors will work with international investors as well, remember. So I've had a chat with her, and she's actually dealt with a few of our investor clients already.
Okay.
So so I know she will take international investors.
Yeah, this is another point that a huge number, I would say maybe 40, I'm just going from my experience, but maybe 40 to 50% of solicitors don't touch foreign nationals because they're just really nervous about anti-money laundering legislation and they don't want to get caught out and they got plenty of other work. So why take the risk?
Yeah,
So it's
sadly
quite,
that is the
yeah.
case. Yeah.
Okay, so the next thing is applicants. So this is fairly similar to the to lender one, and basically it's very open. First time buyer. This is a critical point, so that's great. These people are actually a lot more easy, aren't they,
Oh, they are,
than
but
Gatehouse and
they will lend in Scotland, and that's really the main difference out of all the lenders in the pack. They're the only one that lend in Scotland.
that's
And
interesting.
yeah, so that's very challenging for international investors, but this lender will lend in Scotland.
But the issue
Um,
is that once the term finishes, then you have to find somebody else who lends in Scotland, and if you can't, you're kind of stuck. So,
yeah, I mean,
um,
it's the only one we've got. I mean, I've been doing this job for a while, and we are constantly trying to find people in Scotland to work for international investors, and we just haven't had any luck. So
I think you said you began in 1990, what was it, 96, was it?
98.
98. So
1998.
that's
Yeah.
24 years then.
Long time.
Is it? No, it's more. 98, 2008, 2000,
20,
2018.
24 years. I
Yeah.
tend not to think about it too much.
Well, this is why I like working with you, David, because you actually really know what you're doing. So, okay, next is the non-standard. That's very straightforward. And
So look here,
okay.
guaranteed rents accepted. So this is where we go if we want guaranteed rent plans. So I know you've just highlighted something else there, but
Oh yeah,
it's
yeah.
just dawned on me.
Oh yeah,
So
that's
they do
interesting.
guaranteed rent plans. So this is the lender you would go to in the scenario where you've got the guaranteed rent plan.
Right. Okay.
So,
Then
I mean, we've even done cases with them where they've lent to charities who are tenants. So that's another sort of bone of contention with a lot of lenders because there's a reputational risk to the bank if the tenant is deemed vulnerable and they have to evict them because you've not paid the mortgage. That can be a real big bad publicity incident for the bank. So that's why a lot of them sort of will just turn away from it. But this lender will accept pretty much any tenant. In fact, I can't even recall one they've said no to actually.
interesting.
So,
This is why I like this lender because it just means you get money out you get out of it means you can just get on with it. There's very little messing around. You just do your thing, get the property mortgage sorted out. So what I find with Gatehouse basically is that people get kind of greedy. So they go, oh, I have to have 80% LTV. But that's fine. But then so many other things are at risk because Gatehouse takes so long to do their mortgage applications and their interest rates are, well, they're reasonable, but there's a huge thing here about just get your money out of cash, get it locked up in a property, get a decent LTV, and then just get on the train and go from there. So anyway, all right. So this is, and also we've got the housing. So yeah, so they're just much easier on lending, which is good, and therefore there's less hassle, which just means you can get on with the transaction. Okay, now the next thing is, now this is interesting. Can you just talk us through what that means in effect?
okay, so day one remortgage means that you can remortgage the property after the first day of owning the property, because you may see that some lenders will have a requirement that this needs to be owned for 6 months, whereas this lender will remortgage immediately. But what they want to see is that you've spent some money improving the property. Because if you want to say, well, I bought it for 80,000, it's now worth 100,000, and I want my loan to be based on 100,000, they want to see you've actually improved the property. So you would need to provide.
Okay, so a scenario, just so I'm really clear on this then, we've got our £100,000 house. We've got a max LTV of 70,000. So we've got 70 grand and 70,000 in borrowings. We know that the property needs, say, £6,000 renovation on it to bring it up to good rentable standard. So it was already rentable, but now it's in good rentable standard. And so I then go back to the lender and say, hey, I've spent my 6,000 on this. Can I now effectively remortgage on my same mortgage, or is it a new mortgage? Or I don't really understand.
No, so I mean that kind of scenario, the day one remortgage scenario works on cash or bridging loan
Got it.
transaction,
Okay,
because
fine.
you wouldn't remortgage the property if it's with the same provider. I mean, we can look to do what's called a further advance with the same lender, but typically you'd need to have the account open for 6 months so they can see some payment history, and then
Okay.
they'll then consider lending some more money. But the day one remortgage piece is generally around, you own the property at the moment, but I want to get my cash out rather than leaving it in the property because I want to go on and buy something else. So you don't have to stop in your tracks. And some investors like that because they can keep the momentum going. You don't want to be stuck for 6 months waiting just because it's just an arbitrary date,
Exactly.
6 months. These
Yeah.
guys will consider it. And in fact, all of them will actually. Lender one and 2 and 3 will do it as well, and Gatehouse
Okay.
actually.
All
So,
right.
yeah.
This is all good. Doesn't need to be tenanted. Good, because a lot of them aren't. And then we are on, what's this one? Lender
So these are
3.
their
Okay.
rates. Yeah. So this is where So you can see with all of that flexibility comes the price. So it's not going to work for everybody. These
Yes.
rates.
So
Yeah.
what makes these people extra special? Because they kind of have to be at
They
those numbers.
kind of
That's
cover everything that the other lenders don't they? That's their niche, is that they do the other quirky things that other lenders won't. I mean, the minimum loan is 30,000. We've
right.
done, cases for them. I use them the most, I think, for people in Scotland, or if an investor's got an unusual tenant.
Right.
So,
Okay.
sort of charities and housing associations, things like that. So people can get it to work because they're getting such a strong yield
Yeah.
that they can absorb these higher interest costs.
I must say this whole thing about compromises. So a compromise is buying in Scotland because there's a slightly different legal system with property purchasing and people aren't
Yeah.
that comfortable with, etc. But you get the higher yield as a result. And yeah, so it all kind of evens out in its own way. But the same story here. These are like lender number 2, really, aren't they? Just more expensive and can deal with more tricky stuff. Is that roughly it?
Yeah, yeah, pretty much. Yeah, and they lend on any type of construction type as well. So
Okay.
whereas the others, like, they'll lend on anything as long as it's not
Mm.
falling apart.
And
So
what's the? Sorry, what were we going to say?
I was just going to say, even if as long as it's not got structural problems, it's fine. But they'll lend on concrete, they'll lend on the prefabs. That's their bread and butter,
Very interesting.
really. Yeah.
And what about minimum term?
You can have a 2-year fix with them.
Right.
But really, if you're in Scotland, I think you need to take the long-term view, is that's what it's going to be for the long term.
Okay. And what's
Because we
the
don't have an
term?
alternative.
What's the term
Term as
of the
well.
mortgage?
You can have 30 years as well. So,
Okay.
yeah.
Great. Okay. So that's them. And then okay, so then we have some scenarios and other bits and pieces. So I'm just going to zoom out a little bit so that we can go. There's good old Gatehouse. We know
There they
because
are.
our dear friends, and like they're good. I must say, one thing I keep saying about Gatehouse is they will pay out in the end, but they're going to drive everyone mad. And so when we're doing sourcing and stuff, I always check and double check to make sure that the vendor does not want a quick sale. And sometimes they want a long sale, which is great, and therefore Gatehouse works. But unfortunately, that door is now closed for a while. So here we are.
So the one
Okay.
thing I've learned about Gatehouse, though, over the years is it really is about the packaging. It really
Yeah.
is. you've got to learn what they want and give it to them nice and neat and tidy, and make sure there's no gaps in the information, because they're going to go through it with a fine tooth comb. So if you're not prepared for that scrutiny, then it's gonna take a long time to get through. Whereas if you go into it knowing full well what they're going to do, you will find it'll get done quicker. So you learn as you go along.
So a couple of things. Can I drop a link to? Can I put this on? Have you got somewhere like a Google Drive or somewhere like that? You can send me a link to this document so that can be shared on the video description. Can we do that? Or what do you want to do? How do you want to do this so that people can talk to you? So I guess we put your details in the description, and then they can talk to you, and then you can share all this stuff and whatever, and then we go from there. Okay. So can you perhaps give us a general kind of roundup on what you would do if you were a foreign national? Take two final scenarios, okay? So we know it's the lower cost properties that are working best. So anything under 130,000 in places like Lee, parts of Rotherham and so on, there's some real value there, and the yields are good enough to make this all work. So you're either, let's just start with the first time buyer scenario. Your first time buyer here, what would you do? Lending wise, this is.
I think lender 2 is sort of jumping out at me, because it's got a lower entry level, and they'll accept most scenarios. And at the moment, lender 1 may be a trickier type of lender to deal with if it's your first property, and you may find out they lend less. So lender 2 might be worth considering, just because at the moment they're trying to run 2 cases at the same time may be problematic. So if you're looking at lower value stuff, then I think probably lender 2 might be the best option for you at the moment, and take the 2-year fixed and then review it in 2 years, and hopefully the rates actually be lower.
Yeah, and then switch over to lender 1 at that point. Yeah, so accrue a few properties with lender 2, bunch them up in a portfolio mortgage with lender 1, and then that'll just stabilize everything long term, or even go to Gatehouse if they're an option.
At the time.
Okay. If you're an experienced landlord, in other words, you've got a property in this country and you're interested in going for a kind of higher price point. So a lot of people are looking at £160,000 up to 220, which seems to be the maximum of the viable threshold, as it were. What would you say for those people?
I mean, look, you can still go to lender 2, because if you look at lender 1's rates, they give a discount if a loan's over 200,000. So if we're still not at that 200,000 loan mark, I mean, may even still be saying go to lender 2. But it really just depends on their risk appetite, doesn't it? With the loan term, people might be prepared to pay a bit more for that surety that they've got a 30-year mortgage. So if you're eligible for that 30-year mortgage with lender 1, is it worth saying to yourself, well, actually, I think I'll just pay that extra 0.2 or 0.3%, because then I've got a mortgage for 30 years and I haven't got to worry about it in 2 years' time.
Yeah. Okay, this is really helpful. So there's a lot to think about.
There is.
Yeah, and just what's your final word with Gatehouse, the current situation? I know we talked about it at the beginning, but just any other comments about this? I mean, they will come back open for business. We reckon that they're going to be tighter on their lending, do you think? Just to kind of restrain things a little bit?
Yeah. When they've done this before and they've paused lending, they came back, but they just came back at higher loan amounts. So saying like the minimum loan must be 250,000 or something like that, and then gradually they brought it down. And that's what they did after the pandemic, and that we're now at what was at 75,000 minimum loan. So I'd probably expect to see that. So they may be back, but they may only come back at the higher loan sizes.
Yeah, and so this takes us into another thing, which is that getting money for cheaper properties is relatively difficult for foreign nationals. And the reason lender 2 is so good is that once you've bought a couple of those properties, you can refinance later, etc. But the yields are just so much better. And also, based on my data analysis on this stuff, there's a clear correlation between, believe it or not, lower value properties in decent areas having much more capital growth than higher value properties in higher value areas, if that makes sense. It's just because they're just so much more affordable. And homeowners, if it's a decent area, homeowners just want to get stuck in, get on the ladder and get on with it. There was one other thing I wanted to ask you about, which was, I forgot. So therefore it's not that important, is it? Anyway, David, it's been really, really helpful chatting with you. And thank you so much for this. It's been unbelievably useful. Any final comment you want to share with everyone?
Just that Gatehouse will be back. So try not to worry. They will come back, and just look at alternatives. Lender 2 actually isn't that bad when you compare it to what Gatehouse were offering before they closed their doors. They were offering 5.19, and now this lender's offering 5.49. It's not too much. You probably won't even notice that when you look at the capital growth over the next 2 years anyway. So, if you're ready to buy, don't let it stop you buying.
And what I remember what I wanted to talk about, which we won't talk about now, but hopefully David will come back for more and we'll go through this. And this is the 2008 crash. I would love to talk to you about that because you've lived through that as somebody providing mortgages. There's a big theme here, which is that property crashes happen because people can't get hold of money. And the question is then, we know that we're running in late in the cycle, so we know the market's getting bubbly, and it leads to a big question, which is, do you grab a property now whilst everything's a bit frothy, whilst there is credit, or do you wait till after the crash when everything's cheaper? But the question is there lending? And I would love to talk to you about that in detail. So let's save that one for another day. But anyway. All right. Thank you very much, everyone. Cheers.
You're welcome. All right. Thanks. Bye-bye.